Stellantis stock has been absolutely hammered, down 67.7% from its peak in 2024 and down 31% year to date. It is one of the most hated stocks out there, even though they are paying an 8% dividend. So what's going on here? Well, today we are going to go through our 7-step analysis process to understand why Stellantis, the company behind Jeep, Ram, Chrysler, Fiat, Peugeot and a dozen other brands, is the 5th cheapest company in our entire analysis table. This isn't about finding the best company. It's about finding out if this incredibly cheap stock could be a cigar butt worth picking up, a turnaround, a dividend play, or maybe a company heading for disaster. And to help us understand this mess, we will be using Forecaster website, which is a great place to get an actionable overview of any company, and that is also sponsoring this video. First, let's find Stellantis in our analysis library and let's take a look at our company dashboard. So, the past results tell an interesting story. The 5-year total return shows just 6.3%. That's basically nothing when we consider inflation. The 10-year total returns are better at 50.2%. But remember, this includes the pre-merger Fiat Chrysler period, so we are looking at two different companies stitched together. Our past results score is just 1 out of 3, reflecting the underwhelming performance. Individual insiders own 23.4% of the company. That is huge. The Agnelli family, descendants of Fiat founder, and the Peugeot family still have major skin in the game. We also have 3 super investors holding shares, including Francis Chu and Bill Miller, for whom it is almost 1.7% of the portfolio. And so our investor score comes in at 2.0 out of 3, which is actually pretty solid considering how hated this stock is. Insiders and super investors are not necessarily agreeing with the market. Now, looking at our financial health metrics on the dashboard, we see some red flags. Return on invested capital is 8.4%, below our preferred 10% threshold. Not great, but not terrible either. 5-year average net profit margin is 7.3%. Again, not amazing, but not terrible. Of course, if we go to Forecaster fundamentals, raw data, and look only at the trailing 12 months, we see that they are losing money. Net income is almost minus $2.4 billion and earnings per share is minus 91 cents. Not good, but it gets worse when we get a deeper look at what's really happening here. Looking at their fundamental analysis, the Altman Z-score shows high risk of bankruptcy. The Piotrowski F-score indicates the stock is weak. But what is interesting, the Benage M-score suggests they are unlikely to be manipulating earnings. So at least the numbers are real, even if they are not pretty. But that's not all. Share buyback shows 141.1%. That means they've been issuing shares like crazy. But remember, this is distorted by the 2021 merger with PSA and Fiat Chrysler combined. The shares outstanding history graph shows the massive spike from the merger, and since then the number of shares is going down. So actually, it's not as bad as it looks. Years to pay debt is 4.3, but that is only possible if we look at 5-year average free cash flow versus long-term debt. If we were to use current free cash flow, we just can't calculate it because it is negative. So that is a massive problem. Our financial health score is just 0.5 out of 3. Not good. Moving on to our growth metrics, revenue growth shows 3.6%. Not what we want to see. Free cash flow growth is 0%, completely stagnant. But actually, it is even worse than that. Free cash flow right now, but also at the end of 2024, was negative. So we just can't calculate it. But here's the surprise. Earnings per share growth is 13%. How is that possible? Well, this is a result for the end of 2024. And unless something super surprising happens, at the end of this year, this number will be negative. Our growth score is just 1 out of 3. Here's where things get interesting for income investors. Dividend yield is a massive 8%. That is huge. But the payout ratio is minus 87.1%. Wait, a negative payout ratio? Well, it is negative because they are currently losing money, but still they are paying a dividend. So either they will not pay the next dividend and save money that way, or they will have to take on debt just to pay a dividend, which seems like a very bad idea. But if they will cut the dividend, we should expect the stock to go down even further, even though it is a rational decision for a company. But as we know, Mr. Market is not always rational. The 5-year dividend growth is 0%, and the reason for that is that we can't calculate it because they were not paying any dividends 5 years ago. That 8% yield is either a red flag because it doesn't look sustainable, or an incredible opportunity if they can maintain it. But it doesn't look too probable. Our dividend score is 1 out of 3. But here's where it gets really interesting. As we can see on Forecaster, Stellantis in the last 12 months has a revenue of roughly $146 billion. And the company's market cap? Just $27.7 billion. We're talking about a company valued at around 19 to 20% of its annual revenue. That is absolutely wild. If we go to the balance sheet, we see that its property, plant and equipment is valued at $45 billion, almost twice as much as the market cap. So we are buying those buildings and equipment for almost half of their value. But let's use discounted cash flow analysis to value Stellantis. And because the current free cash flow is negative, we will use a 5-year average one. And we have 3 scenarios. Low scenario, in which we predict that it will continue to decline for the next decade. Medium scenario, where we believe it will basically not grow at all. And high scenario, in which we see a story of Stellantis growing slowly over the next 10 years. And as we can see, with all of these scenarios, it is all green. After applying our 30% margin of safety, low scenario gives us $16, medium $18, and high scenario $21. And the current price is $9.64. And our average intrinsic value with the margin of safety is $18.59. This shows a current upside potential of 92.8%. So, of course, our valuation score is a perfect 3 out of 3. Looking at our overall scores, past results 1, that is weak, investors 2, decent, financial health 0.5, well, that is definitely concerning. Growth 1, that is also poor. Dividends 1, again something to worry about. And valuation 3, so it is incredibly cheap. And finally, overall score 1.4 out of 3. Not great, to say the least. But the market is pricing it near total distraction. If they can just survive and stop losing money, that 90% upside could make this the value play of the decade. Or it could be a value trap of the decade. So what's the verdict? The Forecaster AI agent summary puts it perfectly. Stellantis NV is navigating a complex landscape marked by both strategic partnerships aimed at enhancing innovation and serious operational challenges, including production halts, recalls, and significant workforce reductions. The company's recent initiative in AI and leadership changes signal a potential for positive transformation. If you want to dig deeper into Stellantis or other value situations like this, then check out Forecaster. The link is in the description. And remember to use code BOLD10 at the checkout for 10% off. Thank you, Forecaster, for sponsoring this video. So it seems that for investors with strong stomachs, this stock might be worth thinking about. We are basically buying $1 for 50 cents, if not less. But we cannot forget about the risk, which is substantial in case of Stellantis. And before you go, I want to leave you with a quote that can be applicable here. Be fearful when others are greedy, and greedy when others are fearful. The biggest gains often come from the most hated stocks. But let's remember, they are hated for a reason. If you enjoyed this video, then definitely check out my analysis of Crocs, another very nicely priced company. Thanks for watching and see you in the next one.